Good morning, everyone, and thank you for joining me. My name is Josie Rasmussen, and today I will be presenting the performance review of our Future Leaders and Market Innovators Fund here at JInvest over the 6-year investment horizon from January 2017 to December 2022. Our portfolio is grounded in a clear and disciplined investment philosophy. We manage the fund actively with a benchmark-aware approach that seeks to outperform the S&P 500 on a risk-adjusted basis. The core of our strategy is exposure to innovation, disruption, and market leadership, but always within a diversified framework that spans all 11 GICS sectors to ensure balance and resilience. We don't just take positions, we adapt them. Our macro-aware overlays allowed us to rotate effectively during periods like the COVID crash and the Fed tightening cycles, capturing tactical opportunities while managing risk. This is supported by a disciplined rebalancing process with quarterly reviews to maintain alignment and semi-annual structural evaluations to ensure the portfolio evolves as markets change. Together, these pillars form a strategy that is not just about chasing returns, but about delivering sustainable risk-aware performance through dynamic markets. Moving on to our initial strategy and theme, we approach the fund with a macro-driven and thematically aligned strategy. So, by leveraging the Farmer French three-factor model emphasizing size, value, and momentum, we tilted our portfolio towards high-growth, high-impact sectors, including technology, financials, and industrials. At the same time, we incorporated value-oriented and defensive names to offset potential downside during macroeconomic stress. When it comes to the composition of the portfolio, this chart shows the original allocation of the FLMI fund. We started by ensuring a broad sector exposure across the full GICS spectrum, and then we lead into high conviction positions in the companies who believe we're best positioned to lead future innovation. Top allocations were made to Apple, Amazon, and Johnson & Johnson, combining technology, leadership, consumer loyalty, and healthcare resilience. We also diversified across energy, real estate, and utilities through positions in ExxonMobil, Simon Property Group, and Nextera, allowing us to mitigate volatility during economic shocks. The structure supported our goal of delivering long-term capital growth while remaining agile enough to make tactical adjustments in response to macroeconomic changes. Moving on to our rebalancing, bouncing off that agility. We maintained a structured rebalancing policy throughout the fund's life, with quarterly rebalancing in March, June, September, and December annually. This allowed us to trim outperformers and reinvest into undervalued positions, maintaining exposure alignment while capturing volatility-driven inefficiencies. For example, in Q2 2020, following the initial COVID crash, we rebalanced into Amazon and Apple, both of which rallied over 60% between April and August that year. Conversely, we trimmed Johnson & Johnson after its defensive strength helped it outperform during the March 2020 drawdown. During Q4 in 2022, the Fed raised its rates aggressively. We tactically reduced exposure to interest rate sensitive real estate investment trusts like SPG, and increased allocation to ExxonMobil, which was up over 20% that quarter on energy tailwinds. In terms of structural shifts, our semi-annual reviews prompted increased allocation to Nextera Energy in early 2021. Anticipating the global green energy rotation, this decision ended up paying off, with Nextera gaining 18% that year, cushioning drawdowns in other sectors. Through this hybrid approach, combining calendar-based discipline with discretionary tactical overlays, we improved capital efficiency and the risk resilience without overtrading or overreacting. So all in all, really happy with this, very happy with our strategy, staying really diligent with the reviews, and that agility has kind of let us bounce back pretty quickly. This chart compares the cumulative returns of the FLMI fund with the S&P 500 and also the MSCI growth index in the US over the 6-year investment period from 2017 to 2022. Our fund achieved a total return of spanning over this period 250%, slightly underperforming the S&P 500 at 280. And way further behind, unfortunately, than the MSCI Growth Index. This result falls short of our original objective, which is, I know, disappointing, which was to outperform both benchmarks on a risk-adjusted basis. The underperformance was most evident during the 2022, 2021, and 2022 when high-growth benchmarks continued to rally, driven by concentrated tech exposure and low rate momentum. While our portfolio remained more diversified and defensively tilted, that said, the fund did outperform during key market phases. I also want to note that we captured really strong upside during the COVID recovery following tactical rebalancing into Amazon and Apple. And like I mentioned earlier, that they gained over 60% in the Q2 of 2020. We also provided relative stability in volatile periods with a smoother drawdown profile compared to both benchmarks. While we didn't achieve full alpha over the entire period, the fund maintained strong performance in line with its broader philosophy, prioritizing resilience, discipline, and long-term capital growth. This result encourages critical reflection on our timing, tactical responsiveness, and how we define outperformance, not just in raw returns, but in risk-adjusted consistency. Moving on to our top and bottom contributors. As you can see in the graph here, it highlights the top and bottom contributors to the total portfolio performance over the 6-year period. Each bar reflects the weighted impact of a stock's average return, showing how much each position added or detracted from overall results. Apple and Amazon were by far the biggest drivers, accounting for combined 74% of the total return. Apple alone contributed a massive 43%, reflecting its consistent earnings growth and product leadership. And Amazon trailed pretty closely behind with 31%, driven by that e-commerce strength and AWS expansion, especially during the COVID years. Boeing and JP Morgan also contributed meaningfully, benefiting from that industrial recovery cycles and the rising rate environment. On the downside, AT&T, Exxon, and Simon Property Group had the weakest impact, with sector-specific headwinds in telecom, energy, and real estate. This breakdown reinforces the value of our high conviction allocations and shows how even strong calls can drive overall performance, while also highlighting the need to reassess lagging sectors more efficiently. Next up, let's zoom out into the world. What's been going on the last 6 years? This timeline highlights the key global economic events that shaped market dynamics during this fund's investment period. In 2018, as trade tensions between the US and China escalated, we leaned into defensive sectors like healthcare and consumer staples. During the COVID-19 crash in Q1 2020, we tactically rebalanced into high conviction growth names such as Amazon and Apple, which we later saw paid off. Both of these investments led to the recovery and became top contributors. By mid-2021, as stimulus-driven growth peaked, we held strong exposure to innovation leaders but remained cautious on speculative overextensions. Whereas finally in 2022, as inflation surged and the Fed really began to raise their rates aggressively, we reduced exposure to interest rates sensitive REITs like Simon Property Group and increased weight in ExxonMobil, which benefited from that global energy rally and really pushed us forward. This slide reflects how macro awareness and discipline rotation allowed the LMI fund to navigate uncertainty, while we also stayed anchored to that long-term strategy. So let's move on to some metrics. In this slide, we're going to look at how we present the portfolio's core risk-adjusted performance metrics, starting with the Sharpe ratio. We achieved a value of 516, which is exceptionally strong. This indicates the fund generated more than 5 units of excess return for every unit of total volatility, far exceeding the benchmark of 1.0. Next up, the trainer ratio came in at 6.48, which is also a pretty favorable result. This measure returns relative to systematic risk, showing that the portfolio outperformed what would be expected based on its market exposure. That exposure is captured by our beta of 1.46, indicating a slightly aggressive positioning relative to the market and maybe also our strategy. However, that risk was well compensated, as shown by both of our Sharp and Trainer results. We can also look at that through like the economic events coming in and markets seeing a lot of volatility. Together, these metrics demonstrate that our portfolio didn't just generate strong absolute returns, it delivered them efficiently, which controlled risk and with consistent exposure to high return opportunities. Moving on to Jensen's alpha and some valuation, we're going to evaluate our fund's ability through the to generate alpha or return above what would be expected based on market exposure. Under the CAPM model, our portfolio achieved the Jensen alpha point 12% per month. That might seem modest at face value, but when compounded and risk adjusted, it represents consistent outperformance beyond what beta alone would predict. Our beta 1.46 reflects a deliberate growth tilt. We took on more market risk by targeting innovation heavy sectors, accepting that higher volatility in exchange for higher long-term reward. But as our high Sharp and Trainer ratios showed earlier, that risk was well compensated. To go deeper, we also ran a FAMA French 3-factor model, which again confirmed an alpha 0.12% per month. A rounded number, even after adjusting for size and value effect. But interestingly, both our S&P and HML factor loadings were negative, ending that we leaned into large cap, growth-oriented stocks, as we've also gone into with our diversification strategy, avoiding that small cap and value exposures by design. Our score was 0.97, meaning that the model explained nearly all of our return variation, suggesting that our factor exposure was stable, intentional, and effective. Overall, both models reinforced that our fund's outperformance was not random or beta-driven. It was a result of disciplined, skill-based alpha generation. Finally, some correlation of our fund. This matrix will show the correlation between our portfolio holdings and the overall fund return, labeled FLMI. What immediately becomes really clear is that our core holdings, Apple, Amazon, Johnson & Johnson, and Xterra, exhibit extremely high positive correlation with the portfolio, all above 0.94. This just reflects and mirrors their dominant weight and performance consistency across the whole period. In contrast, we see lower and even negative correlations from Boeing, AT&T, and ExxonMobil. These were deliberate diversifiers. Sectors like industrials, telecoms, and energy were less aligned with our tech growth tilt, which helped to temper volatility and hedge sector-specific drawdowns. Interestingly, P&G, and Exxon show neutral or weak correlation with other stocks, indicating that while they didn't drive performance, they added defensive and non-systemic value. The overall takeaway here is that our portfolio was just a cluster of high growth names. We blended correlated leaders with orthogonal sector exposure, which helped stabilize returns without compromising upside. In closing, the FLMI fund delivered periods of strong tactical performance, particularly during the COVID recovery in early 2021. However, the full 2017 to 2022 horizon, the portfolio unfortunately underperformed both S&P 500 and the MSCI Growth Index. This result reflects a strategic bias towards diversification, defensiveness, and long-term resilience, which sometimes came at the expense of capturing speculative growth rallies. So although we poured pretty heavily into Apple, Amazon, and those growth sectors, we still had to manage some kind of diversification and stay a bit more stable, which damaged us in the end, especially in like this period where there's been so much happening and COVID and everything. Still, the risk-adjusted metrics were quite strong with that Sharp ratio and Trainer, and also a positive Jensen's alpha of that 0.12%. They all point to that a portfolio performed efficiently relative to its risk exposure. Our FAMA French analysis also confirmed that alpha persisted even after controlling those style factors, reinforcing that our performance wasn't just luck, but it was grounded in that consistent process. With that said, this experience shows that more dynamic sector rotation and stronger timing in high beta markets may be required to outperform aggressive benchmarks in a full cycle terms. Going forward, the foundation of this strategy remains solid, but it needs to evolve towards more agile and macro allocation without sacrificing our core discipline. Thank you so much for listening this morning. We at JInvest are going to work really hard. We're going to close down the fund for now, but stay tuned to come look at what we're coming up with next.